Hey guys, today we're going to be going through the basics, reading financial statements.
That's so boring.
I know, I'm sorry, it's boring, but it's super important. You need to know the basics in order to analyze companies if one day you want to start your own business or even just for general personal finance reasons. Be sure to hit that subscribe button if you guys don't want to miss out on videos like this because I'm planning on going through all the different financial statements and explaining them to you guys. Comment down below if you want to see more videos like this. Okay guys, today we're going to be analyzing the income statement, and I promise you by the end of this video, you'll be able to understand everything on this page and you'll be able to analyze companies' income statements. The purpose of a for-profit company is to make profit, and the income statement shows you just exactly how much profit a company has made over a specific time period. This time period is usually yearly or quarterly. The income statement also shows you the amount of expenses that the company had in order to generate its profits. It can give you key insights into the efficiency and profitability of a company. There's two ways we can find income statements. The first way is to search the company you want, for example Netflix, and you type in investor relations. You can then go into their annual reports, and here you can find their annual reports, and within their annual reports you can find the income statement. The other way is to go to the SEC's website and you type in the company's ticker symbol that you want to find. Once you found the company's SEC filings, you can see there's a bunch of different filings. A 10Q is a quarterly report and a 10K is an annual report. And within these quarterly and annual reports is a bunch of information on the company as well as their financial statements. So we're going to go into the 10K. We click on documents and then we click on this file. And now what you're looking at is the company's annual report. You then want to go to item 8, click on financial statements, scroll down a bit further until you see the consolidated statement of operations. This is also known as the income statement. Now that you guys know how to find the income statement, I'm now going to explain it to you and how it works. The first thing on every company's income statement is the amount of revenue they generated over that period. We can see that in 2019, Netflix generated $20 billion in revenue. The next item is the cost of revenue, and this shows you how much Netflix had to pay in order to generate these revenues. These are the direct costs associated with producing their goods or services. And in Netflix's case, this is the direct cost of their streaming platform and also the content they had to make. For Apple, for example, this would be the labor they needed to make their products and also the materials they need to make their iPhones. Once we subtract the cost of sales or the cost of revenue from the revenue, we get something known as the gross income. And we can see in 2019, in Netflix's case, this was $7 billion. So companies have costs that are directly related to the production of their goods and services, and they also have other costs. This includes administrative costs, research and development, and also marketing costs to promote their product. These are not included in the cost of revenue, which is also known as the cost of goods sold. Once we subtract the cost of goods sold and the operating expenses, we then get what is known as the operating income. This is a representation of how much income the company generates from its operations. And if you guys are ever confused about what an item means on one of these income statements, you can click on here. You can press this button, and over here it'll give you an explanation of what this item is. The next thing we have to do is subtract interest expenses and taxes. In order for companies to expand their operations, sometimes they have to issue debt. And on this debt, they have to pay interest expenses. As we can see in 2019, Netflix spent around $626 million on interest expenses. The next item is interest and other income. Companies may have a lot of cash in the bank, and with this cash, they can earn interest. Companies may also gain other income from things not related to their operations. It could be income from maybe their investments that they've made. It could also be income from changes in exchange rates or other things like this. And so once this is taken care of, we then get to the income before taxes. Companies then obviously have to pay taxes, and once these taxes are deducted, we can get net income. As we can see, in 2019, Netflix made around $1.8 billion in income. Once you have the net income, you can then divide this by the number of shares to get the earnings per share. And another thing that might confuse you is you have earnings per share that is basic and earnings per share that is diluted. The basic earnings per share is where you take the net income and divide it by the current amount of shares today. The diluted version is when you take the net income and divide it by the current amount of shares plus the potential amount of shares that could be issued. The diluted EPS will be lower than the actual basic EPS. The reason why the diluted number of shares can be greater than the current number of shares is because sometimes companies compensate their employees with stock options. And an option just means that if a company's share price gets to a certain level, these employees can then use their option, and this increases the amount of shares that the company has. As a shareholder of a company, it is much better to use the diluted number because this gives a more accurate representation of the potential number of shares that a company can have. The last column here tells you the actual amount of shares that they have. So the basic number of shares that Netflix currently has is 437 million. However, if all the stock options were issued, this would be more around 451 million shares. So to get these values, you just take the net income and divide it by the respective number of shares. And that's basically everything you need to know about an income statement. And then here we can look at another income statement for a company called Viacom CBS. You have the revenues, you have the costs for these revenues, you then have selling, general, and administrative expenses, depreciation and amortization, and restructuring costs. And these three costs here are known as the operating expenses. And then once you've deducted that, you then get the operating income. You don't have any interest expenses and any interest income earned. And if a company sells one of its subsidiaries, this will also be included in their other income. And once all these extra things are taken care of, you then get the earnings before taxes. And once you've taken into account taxes, you then eventually get the net income from operations. As you can see in this case, there's also net earnings from discontinued operations. So sometimes companies have to shut down divisions that aren't performing as well. And this can lead to losses in some years and also profits in other years. And if you're a bit confused on this, just do what I did here. And you can see the description over here. So this could include the income from operations that have been phased out, on sale of assets, or from reduction in value of certain assets. And finally, you then get the net income. So as you can see, it can become a bit more complicated, but the general structure is basically the same. But now you have the abilities to read any income statement for any company that you want. What we can do is we can take the data that the company has in their financial statements and move it over into an Excel sheet. And I will be sharing this sheet with you guys. I've done it for Viacom and Netflix. So once we have all this information for both companies, we can then calculate their gross margins, net margins, and operating margins. And this goes without saying, but the gross, operating, and net margins will change based on the industry. To get the gross margin, all we have to do is take the gross income and divide it by sales. To get the operating margin, we do the same, but with operating income. To do the net margin, we take the net income and divide it by sales. And this is important, especially when comparing companies to see how well a company performs. The gross margin gives you an indication of how well the company produces their products or services and how well they manage the direct costs. The operating margin gives you an indication of how well the company manages their operations and their costs of operations. And the net margin shows you how well it's managing all of these things and also their interest expenses. What we can also do is we can calculate the growth rate between years for the growth in revenue and the growth in net income. To do this for a 1 year period, all we have to do is take the starting value, which in this case is 27 billion, divided by the ending value, and then minus this by 1. From the period of 2018 to 2019, Viacom grew around 2%, and the same thing for Netflix. The revenues for Netflix, it grew around 27%. To do it over a 2 year period and get the annual growth rate, there's one more extra step we have to do. We take the ending value and divide it by the starting value. We then have to raise this to the power of 1 divided by the number of years. In this case, it is 2 years, and then we do the same thing and minus it by 1. Over the 2 year period, the annual growth rate has been around 2.38%. So we can see that the growth is slowing for Viacom. Netflix, however, it was 31% and now it is 27%. The difference between these two companies shows you the huge impact that growth and the perception of that company has in the stock market. So Viacom actually has higher revenue and higher net income in 2019. It also has higher gross margins, higher operating margins, and higher net margins. The only difference between Netflix and Viacom is that Viacom is a traditional media company and they are only starting now to get into streaming services. Netflix, on the other hand, is a pure streaming company. They have a lot more subscribers and they're growing a lot faster. Because of their higher growth and the higher growth that investors attach to Netflix, they value Netflix a lot higher. As we can see, the market cap for Viacom is 16 billion, whereas the market cap for Netflix is 209 billion. To me, it does seem a bit crazy that a company like Viacom only has a market cap of 16 billion, whereas Netflix has a market cap of 209 billion, considering the fact that Viacom are also entering the streaming business. I do, however, understand that some of the reasons for this is because Viacom is seen as a traditional old firm and Netflix is a new disruptor in their industry. But it's up to you to decide if these valuations are reasonable for you. Doing an analysis like this can be really useful if you're comparing competitors in an industry. But like I said, now you guys actually know all of this stuff. You guys actually know everything in the spreadsheet. You know how to analyze an income statement as well as compare the income statements of different companies. And if you have found this video helpful, please remember to smash the like button, hit that subscribe button. Also share this video with your friends because this is knowledge that a lot of young people do need to understand and it'll help you greatly in your future. If you guys do want me to continue this series, also let me know in the comment section down below. Thank you for watching and I'll see you guys next time.